I got nothing to add. Beautifully said. Jack, come on in.
Great points all around. So Jason, you mentioned the dispersion trading, shorting equity vol, and going long single stock vol. It's funny, I wasn't hinting at that, but that was another question I wanted to ask. But let's suspend that for a moment. I want to ask you about gamma scalping. So you'd say you would have made money doing gamma scalping this year, which is essentially like you're long a straddle and you delta hedge it. I thought the fact that realized volatility on the index level was low this year would imply that you weren't making money doing gamma scalping, or no, or is it the fact that you're doing it on an intraday basis and intraday realized vol has been higher?
Yeah, the latter.
Okay.
Sorry, the latter. Yeah, you can be long a straddle and then just restriking your deltas on an intraday basis. And then people that are better at it, like as we've seen, like these shifts quite violently intraday. Like we've had days where the S&P's down 4% and then it spikes going back into close. So obviously, if you have somebody that's a discretionary, long gamma trader that can restrike and basically reset and rebalance on an intraday basis, they've been doing very well throughout this year.
Yeah. That's important, but the VIX measures day-to-day vol, right? So the fact that the S&P opened at 3,200 or 4,200 and then went up to 4,300 and then closed at 4,200 does not matter for the VIX.
Yeah, I forget that we're also a podcast because I'm shaking my head thinking like people can see it too.
Right.
Yes,
yeah.
Corey and I are doing the same instead of giving you the verbal,
nodding our heads.
Yeah.
Okay, I got it. Yeah, so let's see. I guess now let's go to the dispersion trading. Why do you think that what is the factor that can explain the dispersion between realized single stock vol and index vol? The fact that it's much higher for single stock vol. I'm thinking of a specific thing, and that I'm thinking of the correlation between the fact that it's not that money's been flowing out of ARK.
Your bet's on correlation. Yeah, it's a correlation bet more than anything else. And
it's been going out of technology and going into XLE. That's what it's. Yeah.
Or you see the vol in technology and you're not seeing it at the index levels, so to speak. So the idea with it's dispersion is really a correlation trade. So just to be brief and talk about it in a rudimentary sense, it's like you're basically short index vol, long single name. So you can do that by going long short a straddle on the index or long a straddle on single names. And a lot of people are trying to replicate a basket of the index through single names. So they might be, 50 single names that are representing the 500 names, and they're trying to, it's an implied correlation. But a lot of people will do even dirty dispersion where they are not trying to replicate the index with their single names. They're actually trying to pick single names that will have higher vol. So that's why they're short index vol, higher, like long vol on the single names, but not trying to replicate the index. So there's multiple ways of doing it, but that's the idea. You're right. It's a correlation bet at the end of the day.
Yeah, Jack, to that point, what could be driving single name dispersion? Could be a bunch of flow trades. So you've seen, for example, fundamental hedge funds degross significantly this year. That means they need to buy back their shorts and sell their longs. So you could be getting downward pressure on traditional high quality hedge fund names, your sort of hedge fund VIP 13F names, and all the stuff, the type of junk that they're normally short can be getting potentially squeezed up, right? And so that can cause dispersion. You've got folks like Jem Carson, again, shout out to Resolve Rifts going on after this, who's having an interview with him, who would argue that delta hedging of options dealers at the index level can keep index vol artificially low, but that is going to force dispersion in the underlying names to keep that index vol low. So if you have some sort of market event in Google, index vol is low and Google's moving, it means everything else has to move the opposite direction of Google to make the index math work. It's hard to know, right? We should say that the index should follow the underlying stocks. But if we're hedging at the index level and keeping the index trading at a certain price, well, the math can work in reverse too, where you can know the right price for a stock based on what the rest of the basket's trading at. So there's a bunch of theories as to, from a flow-based perspective, what can drive this sort of relative vol in the short term. One of the things we certainly do know is that factor volatility, when you look at baskets of value or growth or momentum names, small cap, defensive, quality, cross-sectional factor vol has been incredibly elevated since March 2020. We've had tremendous turnover in factor baskets. Things like momentum has had abnormally high turnover compared to the last decade. And I think it's just to the point that cross stock dispersion remains really high from a performance perspective. There's a lot of volatility there. And it feels like there's high vol at the index level. I know you mentioned this year hasn't been a high vol year. I will point out we're moving 2% a day, like every other day. That's pretty high. But at the underlying stock level, it's much higher.
And to your point about the factor vault, like was it October 2020 is like a perfect example of that, where you just had a violent rotation from growth to value. It's like that's one of those examples. And speaking of which, by the way, I know this is kind of one of your favorite questions, or maybe not, is Menahem in there said, do you suppose that since all these managers degrossed already this year, that maybe there's a shit ton of risk to the upside if they decide to lever up again?
Oh, man.
I know you love upside raised questions.
Yeah. I love this question. Yes. So this is something I think I've been actually talking about on Twitter a little bit, that what you saw was that risk parity had significantly degrossed over the last several months. You saw managed futures who were degrossed both in equities and then short equities, but because vol was higher, they had degrossed their total notional exposure. You saw hedge funds had degrossed. All of these have potential buying pressure, right? When their total exposure is lower, there's really one directional flow potential. It doesn't mean it's necessarily coming in, but if you were to see the market start to move higher, right, they've run out of selling pressure. All they have is potential energy to the upside. And if the market starts to move higher and vol starts to compress, they become natural buyers that can potentially drive the market up further. And that's exactly what you saw. When was it, March or April, when we had that really violent 11-day rally? If you were tracking CTA flows, for example, they bought hundreds of billions of dollars of S&P exposure, which they then unwound immediately after when the market rolled over again.
And then, so part of that question, though, you know, you and I, when we argue privately, I don't think we argue, like we tend to agree on too much, but we tend to get into semantical arguments a lot. And maybe we'll get to the one from this week that you got into. You brought out the semantic trolls on Twitter.
What was I thinking?
But Menahem said that the risk is to the upside. And that's why I've always asked you, like, what does that mean when most people are long beta? The risk is to the upside. Is that not a bonus for people that are long beta?
Yeah, I think again, it sort of comes to what's your natural positioning. When we say the risk is to the upside, the way I typically interpret it is like, where is the path of pain for the largest sort of group of investors? And not to say that systematics are the largest group of investors, but the path of pain right now for a lot of people who are naturally degrossed would be the market moving up. They would have to chase. Versus if the market keeps moving down, they're very well positioned for that. So when you talk about who's driving short-term flow, the pain trade is to the upside right now, not the downside.
Got it. And by the way, shout out to Gregory. He said, finally able to tune in live. Welcome, Gregory. Glad you were able to tune in live.
By the way, I do enjoy this comment from Mateo Blanco.
Yeah,
that we're guests, by the way, I guess, on our own show. We're guests on our own show, and we weren't paying attention to Jack's question.
Yeah.
And I guess we need new hosts for this show. Jack.
Mateo, yeah, Jason and Corey are the hosts. I'm not the host. I'm sort of the producer that every now and then gets to chime in. But I think that's actually really funny.
And maybe
in that one.
Yeah, we need to pin that one, and also that's like par for the course for our show in general. But like also on Jack's 7-part questions, I was thinking about the first 5 parts and I missed the last 2.
I gotta start taking notes.
I know, exactly. You're
coming with the heaters this week, Jack.
Yeah. God, I actually really there's something that we just were talking about that I wanted to ask you about. Well, first I want to say that, yeah. So on growth versus value, when you say there's been a huge, money going out of growth to value, Corey, I figure you have a very rigorous and quantitative index of all these sort of things, and you measure them very quantitatively. I would look at it much less rigorously. I'd just be like, wow, ARK's down 50% this year. XLE is up 50%. Energy's value. Of course, you can do like VUG to VTV and stuff like that. But my question is, are there companies that are just like structurally unprofitable companies that have that I think they're too small market cap, and honestly they're too absurd for probably to be in an index, like a salad company that for the first quarter, they made $1 million and they lost in revenue, and they lost $16 million, and like it's going to de-SPAC pretty soon, like that. I like those companies. I just think are not going to do well. And to the other person's question about like, yeah, you could have a Carvana could double, Salesforce could double, it could triple, but like I don't know, the salad company, I don't have a good feeling about it.
Yes,
I'm not long.
I don't know if I explicitly said there was flow going into value. You saw a rotation in performance, and you definitely saw in 2021 flow go into value. That has actually tapered off this year as far as the stuff that I've seen from Goldman and other banks, as well as some of the numbers I track. I haven't seen the strong rotation of cash flow into value strategies continue to go. That's not a huge surprise to me, because a lot of that is always lagging performance. And what you saw was value really ran in late 2020, early 2021, and then mostly flatlined relative to the market. Has been running again this year. I would expect, flows will once again chase that performance and potentially extend it. You did just see momentum and have been seeing momentum rotate into value names. So I would expect multi-factor quants as well as momentum quants to begin rotating more into value. And the way they express that might not be, right, buying ETFs. Some of the flow will be hard to track. They'll just be buying the underlying names. But I do think you have seen continued demand. Not as easy as just looking at like performance necessarily of XLE versus ARC to say where flow is actually going. Flow is a component of it, but securities can reprice having nothing to do with flow.
This also goes back to like Menaham's earlier question about the risk being the upside. Is like you're saying the quants and everything, until like vol comes back down a little bit, and that vol targeting, that's when they can start regrossing their books. And really, that's when you see even more flows. But when Menaham had another question about what, maybe explain the term flow. How does flow move into or out of an asset if every trade is balanced with buy versus sell?
Yeah, this is great, because it's sort of like, how can there be cash on the sidelines, right? If every security is already always owned by someone. The way I always think about this is where's the marginal demand coming from? So if you've basically had a huge amount of people sell cash equities because they want to get out, they're putting downward pressure to find a clearing price where buyers are willing to step in, right? And so that flow creates repricing pressure, as they are the side of the order book that's having the greatest marginal impact. Less true in the derivative space, right? There, for every buyer, there is, in theory, a seller, but you can see part of that market just disappear, right? So it's definitely, yes, there is always a matching side of the order, but to me, it's about who wants to get the orders done and at what price. Systematics, not to say that they're totally just going to execute blindly, but when they want to buy, they're going to end up buying, and the sellers therefore have sort of the edge in terms of at what price they can sell at. So flow is all about sort of marginal pricing pressure that can move prices over time, less about, yes, for every buyer, there has to be a seller.
Well, like you said, the difference when we're starting about derivatives is like you can kind of create them about whole cloth, and people are just taking offsetting risks. So it's
right,
like you said, they can pop up and go away just as quickly.
Yep.
It's not quite that zero-sum game of buyer versus seller. It's more, hedgers and market makers and non-economic players. So there can be like a kind of a win-win all the way around. There's a second and third order effects to the way people are structuring those books, and so it's a little bit different from just the stock game. Jack.
All right. Now I want to ask you about, now I got you guys all warmed up. I want to ask you about inflation.
Are we going for inflation?
We're going
there
for inflation.
We go.
Why, in what way do you think in any way it changes the games, correlations between stocks, bonds, the valuation of future cash flows? And if you think that it does make a difference, question one, do you think it does make a difference? And question two, do you think it's possible to predict it in a routine, sort of rigorous way? And if not, sort of why? Because I know both of you typically are not, studying the CPI basket at, right before it comes out.
Corey, before we can, maybe the part of this clarification from Jack's question is like, correct me if I'm wrong, Corey, but I always think about it as longer time horizons and rate of change. So like when we have one print, I don't really pay too much attention. Is that the kind of the way you see it too, or?
Yeah, Yeah, I mean, right. Markets are forward looking. A lot of the time, it's about the rate of change of the value, not the value itself, and the value versus expectations, I guess, in the short term, and what a meaningful miss could mean for potential policy. Right. I think a lot of, not to say that today's flows are explained by the print, but a lot of the chatter today was, well, today came in hotter than expected and hotter than we thought guidance was saying it would come in at, and therefore does that put 75 basis points on the table? And 75 basis points would, right, in theory, create a meaningful repricing potential in equities because you're changing the discount rate.
Another part of that is I was one of the calls I was on earlier today was with Noel Smith at Convex AM, and we were talking about the idea that everybody's pricing in rate hikes, and maybe now we're pricing in higher rate hikes. But what we were talking about is like the actual between meetings, you could have a rate hike, and now that's kind of on the table. And so did that also lead more to the sell off recently? And we were talking about how a lot of investment banks, especially Goldman Sachs, were putting out notes yesterday before this CPI print. So we're like, there was a little bit of like maybe front running there yesterday because we actually saw, that sell off prior to this morning CPI print. And we sold off a little since then. But that gives an idea of like, it was interesting to see, who was kind of already talking about that CPI print before it came in today and what that ended up looking like. And then now is it on the table not only for rate hikes at the scheduled meetings, but could we have an intra-meeting rate hike? And then that really roils markets more than anything else.
Well, actually, Jack, I would love for you to come back because now we will talk a little macro, because I think when you talk about central banks, there's really two tools that they primarily have, right? They can set the discount rate and they can set guidance. And guidance is a really important tool that they have in terms of trying to create market stability. Saying they're going to do something gives the market confidence in many ways. They have been adamant about 50 basis points, 50 basis points, 50 basis points throughout for the rest of the year. If suddenly 75 basis points is on the table or an unscheduled hike is on the table, that means they lose all credibility, and guidance potentially goes away as a tool for central banks for the near future, which could bring a lot of volatility